So how to deal with all the economic uncertainties and secure your financials and make sure you're still generating some income? Investing, right? And generating passive income by investing is one of the best strategies out there. Let's go. Hello everyone, Alex is here. I hope you're doing well. I hope you're staying safe and positive. Today we're going to be taking a look at the best high dividend stocks with 6% above dividend yields that can bring you passive income on a regular basis, and you can forget about all the economic conditions and all the stock market uncertainty for the nearest future. Because investing into high dividend stocks is actually a convenient and cost-effective way to generate your passive income. And investing into stocks is free. You don't have to pay any commissions on top of that. You can just generate your passive income and you get everything for yourself. And the best way to do it actually is using your tax shelter accounts like TFSA or RSP. And why TFSA is great? Because whatever you are generating from your TFSA account is all yours, no taxes paid on top of that. So the Canadian government started this tax-free savings account or TFSA in 2009. And every year you have a certain fixed amount you can contribute to this account that will do something for you or it won't do something for you. It depends where you're actually gonna open this account. And you can open this account, for example, with Questrade or Wealthsimple, with any investment brokerage's account. And then you can contribute your yearly limits to this account and then buy stocks, ETFs, whatever with money you have there. And whatever you generate on top of that, it's all yours and you don't have to pay any taxes on top of that. And if you haven't contributed to this account since 2009, your maximum contribution room up to today is going to be $75,500. That's a big chunk of money, right? And if you invest all this money in a smart way into dividend stocks, for example, you can generate almost $400 as a passive income every single month. How cool is that? That your money works for you. You don't have to pay any taxes on top of that, right? So it's all yours. How are you going to use it? It's up to you. You can pay your bills, you can buy your groceries or whatever. Or you can reinvest back and generate even more from your investments. And again, why dividends are important. So first, because stock markets historically have corrections, like significant corrections, around like 30, 40, 50% every 10 years or so. That means that your entire portfolio account goes down by 30, 40% approximately every 10 years. That's a bummer, right? But if you have dividend stocks in your portfolio, the dividends will keep coming to your account no matter what. And that's the beauty of dividends. If you invest smart into proper and correct dividend stocks, that will allow you to generate this passive income regardless of what the economic conditions are. This is amazing, right? That's what we're gonna do. Let's take a look what I have today for our 6% high dividend yield stocks. And the first one is my favorite dividend stock on TSX. They have super high dividend yield of 6.7%. They also increase their dividends consistently for the last 26 years. And they apparently right now in an undervalued share price, which means that it's a very good buying opportunity and you can secure this dividend yield and keep growing it and keep contributing it to this stock in order to get this compounding working for you over the long-term period. And what's the company? It's Enbridge. The ticker symbol is ENB.TO. And Enbridge is an amazing dividend stock. They showed it over the last 26 years and they're gonna keep doing it going forward. And how they can sustain paying all these dividends and why this company is very well lined up for the same performance, the same consistency over the long-term period. Enbridge is involved in a highly regulated energy transportation and distribution business with over 40 revenue-generated sources. And when we are talking about highly regulated business, it means it's not gonna go anywhere. Everyone needs the services they provide, which means for investors like you and I, that we're gonna keep getting these dividends back and these companies can survive any economic conditions. And Enbridge, for example, earns around 98% of its cash flow from highly regulated or long-term contracts, which brings a lot of stability to its financials. And because of these steady cash flows, company has paid dividends uninterruptedly for the last 66 years. And they also increased their dividends at approximately 10% per year for the last 26 years. And this is exactly one of the best ways how you can get compound growth from your dividend investments. And Enbridge is also keep investing and reinvesting into their own business in order to grow it, even becoming a bigger company over time. The company plans to invest around $17 billion over the next 3 years in order to grow and expand their asset bases. And moreover, company is also focusing on increasing their renewable power portfolio, which is great for them, for us, for the planet, for everyone else. Let's see what we have from our metrics for Enbridge as of today. Their current market cap as of today is around $100 billion. This is crazy. The company grew significantly over the last 10 to 20 years and even over the last couple of years. They're showing that they can not only increase and pay their dividends, but also reinvest in their business and grow it significantly. Their current dividend yield is around 6.7%, and their 5-year average dividend yield is actually at 5.6%, which means that the current share price apparently is a little undervalued, which is great for investors who want to either invest into Enbridge or add to their current positions of Enbridge. That's what I did recently, and that's what I keep doing going forward. Enbridge pays their dividends on a quarterly basis, and as I said before, they increase their dividends consistently for the last 26 years, with an average rate of 10% increases every single year. This is crazy. Their current payout ratio is a little worrying, is around 104%, but I'm looking forward to their next financial statements to see what's going to happen with it and actually what happened to it since last time they reported it. Looking at their share price over the last 10 years, it actually increased by 57%, and that's only the share price, not including the dividends on top of that. So the company keep growing over a long-term period, which is great. That's what we want to see from our long-term investments. And we also get sustainable and great dividends back, which is great, right? And their beta parameter is also very sustainable as a 0.95, which means that this stock is not volatile at all. And that's great for us. So we shouldn't worry about it. We just need to keep investing with a dollar cost averaging approach. That's what I do. And that's, I think, one of the best ways to not miss out on the best investing days over the year. Their current share price is around $49, and I would say this is a pretty affordable price for a stock like this, especially for the dividends you're getting on top of this from this company. And the drip amount for Enbridge is around $3,000. So if you invest this amount into Enbridge, you can reinvest your dividends automatically every single quarter in order to get another share of Enbridge. So Enbridge is one of the best stocks, dividend stocks on TSX, is actually my favorite dividend stocks. I think it's actually one of the first ones I invested into when I started investing, but I also love them because they keep growing their dividends significantly over the long-term period. And in my opinion, this is one of the best dividend stocks, high dividend stocks on TSX, and especially for those who wants to generate their passive income by investing. Let's move on, and the next one is going to be Pembina Pipeline Corporation. The ticker symbol is PPL.TO. I'm actually very bullish on this stock. I have it in my portfolio and I love it. And the best and the most important reason why I love it, because they generate me dividends on a monthly basis. So I get paid dividends every single month, and I set it up that I have a drip, so I keep reinvesting into the stock with its dividends on a monthly basis. This is the best way to compound growth your dividends. And Pembina provides energy transportation and midstream services. And thanks to its highly regulated business, similar to Enbridge, the company has been paying a dividend uninterrupted since 1997. This is great. And over the last 10 years, the company actually has raised its dividends on approximately 5% per year, consistently. This is great as well. And currently, the company pays dividends every single month with a dividend yield of 6.2%. This is amazing, and their regulated business can sustain their dividends going forward as well. The other cool thing about Pembina Pipeline right now that you also need to know is that they're in the talks of acquiring Inter Pipeline Company, and that actually can increase their dividends by 10%. So I'm very bullish on Pembina. I like it a lot. Let's see now what we have from their metrics as of today. Their current market cap is around $22.2 billion, so the company is huge, they're not going anywhere, they're also started to acquire other companies, which is great, so they have plans to increase their business over the long-term period. Their current dividend yield is around 6.2%, and their 5-year average dividend yield is actually around 5.5%. So right now the stock price is actually apparently is undervalued, which also and again tells us it's probably a great time right now to secure this dividend yield and to invest to this company or increase your positions in Pembina pipeline. As I also said before, they pay their dividends on a monthly basis, so this is great. You will start getting your next dividend payment as soon as next month from your investments. Their share price over the last 5 years grew by 35%, and over the last 10 years it grew by 60%. So we see this consistent share price growth, right? But we also see the consistent dividend growth over the last 10 years. They increased their dividends at a rate of around 5% every single year. This is great. It's not, of course, similar to what Enbridge is doing with their 10% increases every year. It is a very solid number for their dividend increases, and they're not stopping here. They're actually gonna keep up with it going forward. That's my plan. At least that's their plan, I guess. And so I'm bullish on it, and we'll see what's going to happen. Their beta parameter is at 1.75, so it's a little volatile over the short-term period. But again, if you're planning to hold it forever, or at least for the next 2, 5, 10, 15 years, then you shouldn't worry about that. Their current share price is around $40, so it's also a very affordable stock to have in your portfolio. The drip amount for Pembina pipeline is around $7,900. So that's the amount you need to invest into this stock if you want to get your drip set up and reinvest your dividends every single month. And Pembina pipeline is also a part of S&P TSX 60 index, and if you invest with the current price of $40 into this stock around $30,000, then you will be getting and generating every single month around $156. This is great. This is the way how you start your passive income journey via dividend investing. And the final stock for today is going to be one of the real estate investment trust, which means they're going to give you monthly dividends as well. And it's Northwest Healthcare Properties. And the ticker symbol is NWH-UN.TO. This is a great dividend stock which pays monthly dividends with its forward dividend yield at around 6.22%. The company owns and operates around 186 healthcare properties spread across 7 countries. So their portfolio has a pretty good diversification, and they keep increasing it year over year. And currently the company is completing the acquisition of the Australian Unity Healthcare Property Trust, which owns around 62 hospitals and medical facilities. They also went through some acquisitions last year when they acquired 10 high-quality hospitals in the UK. That also brought him a lot of cash flow back, and it shows that the company is improving and growing their business year over year. So the company growth prospects looks very healthy. They're in healthcare, they have to be healthy. The company has a very good occupancy rate throughout their entire portfolio at around 97%. And the rate on their international portfolio is even higher, at around 98%. Let's take a look what we have for them in our metrics today. Their current market cap is around $2.5 billion. As you can see, the company is not big, but they started doing these acquisitions already, which is great. The company is bullish on themselves. They keep improving their portfolio year over year. Their current dividend yield is around 6.2%, and their 5-year average dividend yield is actually at 7.2%. So it might mean that the company's share price right now is a little overvalued, so you need to watch out for that. But if you're bullish on this company and you think you're going to invest long term, then you shouldn't worry about that. The company still has a very high dividend yield as of today, and if the share price is going to drop, they're going to keep paying your dividends, and you can invest even more into it to secure even the higher dividend yield at that time. As I said before, they pay dividends every single month, and the way they do it is because the company collects rent for their properties, and the part of the rent goes into their dividends to their investors. In terms of their share price over the last 10 years, it actually didn't go anywhere. It's pretty much flat. So watch out for that. If you're looking for a growth stock, not for a dividend stock, then this is probably not the best one for you. But also remember that the companies start to acquire a lot of companies as of last year and this year. So I think they have a pretty good potential ahead of them. So I'm bullish on this company as well. And because they're in real estate, in healthcare, there's not a lot of stocks who are in this business. So that's why this is one of the best ones to have in your portfolio to cover that sector as well. Their better parameter is 0.77, so the share price is actually not very volatile over the short-term period. So keep that in mind. As of today, their share price is around $12.83, which makes this stock very affordable for all the newer investors, but also all the other investors as well. And that also makes their DRIP a very low number, as it stands at $2,600. So you gotta invest $2,600 into this stock in order to get enough dividends every single month that you can reinvest back into the stock in order to get another share of this stock, which is great. This is the way the dividend compounding works. I keep saying this, but I think it's very important. Everyone needs to know about it. Because the best way the investment works is when it's all automated and you don't care about what is happening there. And for dividends, the best way to do it is via DRIP, because you automate your dividend reinvestments and they keep growing for you. You don't have even to know what's happening, because they're going to be reinvested back into the stocks they came from on a sort of dollar cost averaging approach, where you're going to be still trying to time the market. But the important thing is it's not timing the market, it's time in the market. Think about it. And now if you equally invest into these three stocks, your yield is going to be at 6.3%, which is great. And for example, for your entire TFSA account, that would mean that you will be getting around $400 every single month from your investments. This is a great way to start your passive income through investing. And with that, thank you for stopping by. Don't forget to smash that like button pretty hard, subscribe to my channel, hit the bell, and I'll see you around. Stay safe out there and keep investing. Cheers, bye.